It is the 15th of the month. You wake up, pour yourself a cup of coffee, open your banking app on your phone, and there it is, a direct deposit for $800. You didn't have to deal with angry clients. You didn't have to work overtime. And you didn't even have to sell a single one of your shares to get it. That money just showed up because your capital went to work for you while you were sleeping. That is the promise of monthly dividends. But how realistic is this if you have, say, $100,000 to invest? Is it actually the ticket to financial freedom? Or is it a high-yield trap disguised as passive income? I spend way too much time thinking about the psychology of passive income and how we build actual systems to escape the rat race. If you're someone who is tired of watching your portfolio bounce up and down without actually putting cash in your pocket today, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Look, most financial advice on the internet tells you the exact same thing. Buy an S&P 500 index fund, wait 40 years, and cross your fingers that the market is up when you decide to retire. And don't get me wrong, that is a solid strategy for long-term growth, but it has a massive psychological flaw. You cannot pay your rent, your groceries, or your power bill with S&P 500 growth unless you sell your shares. And selling your assets when the markets are down physically hurts. It goes against our entire financial survival instinct. Here's the thing. We human beings are hardwired to think about money in monthly cycles. Your bills are monthly. Your car payment is monthly. Your salary is monthly. So, when you invest in traditional stocks that pay dividends every 3 months, or funds that only focus on the price going up, there is a disconnect in your brain. You are playing a decades-long game while living a month-to-month life. This is exactly where monthly dividend markets change the game entirely. Let's run the hard math. Say you take that $100,000 and deploy it into a diversified portfolio of the best monthly dividend stocks and funds. We aren't talking about garbage companies on the verge of bankruptcy. We are talking about real estate investment trusts, or REITs, companies that literally own the pharmacies and grocery stores you shop at. We are talking about business development companies, or covered call ETFs. If you build this portfolio correctly, you could realistically target a dividend yield of around 7 to 9% in today's market. Let's be conservative and use 8%. 8% of $100,000 is $8,000 a year. Divide that by 12. And that is $666 flowing into your checking account every single month, like clockwork. Now you might be thinking, isn't total return more important? Aren't I going to miss out on massive growth if I chase these high yields? And it is a fair question. The short answer is yes. If you put 100 grand into an aggressive tech growth fund, in 10 years, the on-screen value of that portfolio will probably be higher than your dividend portfolio. But paper total return does not pay the mortgage. Here's what most people don't realize about money. Wealth isn't just a math problem, it's a behavior problem. The reason 90% of people fail at investing isn't because they picked the wrong stocks. It's because they panic and sell during a market crash. Or they get bored and stop investing entirely because they don't see tangible results. Monthly dividends solve this behavior problem by creating an undeniable dopamine feedback loop. When you see that actual cash hit your account every 30 days, your brain registers an immediate reward. It makes you want to save more, cut out dumb expenses, and keep feeding the machine. Think of it like buying a cow. The growth investor buys a calf, feeds it for years, hoping it grows massive so they can sell it for a huge profit someday. The dividend investor buys a dairy cow. It might not grow into the biggest cow in the world, but you get to milk it every single day. And if the market price of beef drops by half in an economic downturn, you don't care at all, because you are still getting the exact same amount of daily milk. This is where it gets really interesting. The true power of this $100,000 doesn't happen when you spend the $666 a month. It happens when you automatically reinvest it. When you turn on the dividend reinvestment plan, you create a mathematical snowball effect. The first month, that $660 buys more shares. The second month, your original capital plus those new shares generate an even bigger dividend. Let's say the market crashes 20% tomorrow. Most investors are panicking, losing sleep, posting on forums that the world is ending. Not you. In fact, you should be thrilled. Why? Because your $700 dividend is suddenly buying shares at a 20% discount. You are accumulating assets on sale automatically, without having to make the terrifying emotional decision to buy the dip. The mathematical system does it for you, taking your emotions completely out of the driver's seat. However, and you need to hear me on this, you cannot just chase the highest yield blindly. I have seen way too many people dump their life savings into obscure funds offering a 15% yield, only to watch the company slash the dividend in half and the stock price plummet to zero. That is what we in finance call a yield trap. A company usually pays a massive percentage yield because its share price has tanked, meaning the institutional market already knows the company is in deep trouble. To build a bulletproof $100,000 portfolio, you need brutal diversification across sectors. You might allocate $30,000 to high-quality REITs, indirectly owning thousands of commercial properties that pay rent every month. Then, you might put another $30,000 into income ETFs that use option strategies to generate cash from market volatility. The remaining $40,000 could go into traditional dividend aristocrats or premier corporate bond funds to anchor the ship when the weather gets rough. At the end of the day, investing $100,000 into monthly dividend stocks is about so much more than just an extra $700 a month. It is buying something most people spend their entire lives chasing and never ever find absolute peace of mind. It is knowing that no matter what happens to the global economy, no matter what happens with office politics at your job, you have an independent, steady stream of cash that nobody can take away from you. The biggest, most destructive mistake you can make right now is analysis paralysis. You do not need $100,000 to start building this machine. You can turn on this monthly feedback loop today with just $100. Buy a single fractional share. Feel what it is like to get that first $1 dividend deposit. Let it shift your psychology from being a constant consumer to a business owner. The time is going to pass anyway. You might as well be collecting a check along the way.